guess another related impact has been the consumer's willingness to purchase increasingly big ticket items. There's been a real upgrade for products that facilitate a good home living. So for example, in the UK, John Lewis, a real staple department store for the middle classes, has recently run out of coffee machines in one of the stores we noticed. So it's people really upgrading their coffee product they drink at home whilst working at home, so emulating their work environment. And that goes all the way to sort of bigger ticket item like, high-end audio products, which we've seen sort of taking a real increase in like-for-likes as people want to upgrade the living environment. If you talk about health and wellness, people can't go to the gym and haven't been able for a while, and have been looking for alternatives. And we've seen some big fundraisers for Peloton and Peloton type competitors. There's been a fundraise announced over 450 million for Peloton competitor as people want to exercise at home. So on the one hand, people go and move to online classes, online yoga, etc. But then also physical products that can be facilitated from home.
The impression we have since retail stores have reopened is that it's here to stay. So the percentage of online sales has jumped and is not looking that it's going to go back to where it was pre-COVID. So it's also pushing investors towards these type of models where before the crisis there was still, I would say, question mark on what are the winning models, what are the good KPIs to be able to sustain investment going forward. And what we see now is corporates acquiring independent pure player in e-commerce, and therefore investors, private equity investors looking at the sectors as well.
The interesting thing that's occurred is that if you look back call it 3 to 5 years ago, most of that e-commerce growth was being driven by Amazon. Amazon was the category dominant play. They still are in many respects. And their growth was really unfettered growth. The interesting thing today is Amazon continues to grow and continues to be obviously a very large player in e-commerce. But what we have seen is that many of the category leading retailers that have invested heavily in e-commerce over time are also growing very significantly and actually doing quite well online, even against Amazon. So a couple of examples of it. Williams-Sonoma, and this harks back to the kind of the nesting theme, is at its all-time high stock price, and almost 60% of its sales now are online as a result of both its brand strength as well as a really efficient omni-channel and e-commerce platform. And you could go down the line and find examples of that in many different sectors. Best Buy is at its all-time high stock price for the same reason. And others, fit into that mold. And so I think it's really compelling that retailers have evolved to be able to compete against Amazon. The last point I'd make on this is that retailers have, obviously in one respect, that it's an asset to have a store base. In another respect, some of those stores can be issues because either they're too big or they're not in the right locations anymore or what have you. Retailers have evolved to use their stores now as distribution points for their e-commerce businesses and be able to fulfill to the customer very quickly. In the same way that Amazon does that, retailers have now done it by utilizing their store base. And so I think that evolution has really created something special for the retailers that have invested in their business.
A second lockdown might put to an end a number of, so-called zombie companies, particularly in retail, some in leisure, and there might be transaction opportunities for either brave investors or investors with existing portfolio companies who want to add on, good value opportunities. For example, we see in fashion the acquisition of lots of interesting brands by brand consolidators at very low prices.
The other aspect that is very important is capital. And retailers really need to be capitalized well to be able to execute on putting in place a business model that can not only compete with Amazon, but can really fulfill what the customer is looking for today. And so what are a couple of those things that retailers need to invest in? One, it needs to be a seamless environment, a seamless opportunity for the customer. The customer needs to think about that retailer, whether they want to buy from home, go to the store, buy from home and go to the store and pick up, or anything in between. And it needs to be very symbiotic. And it's even more than omni-channel today. I call it kind of seamless channel. It needs to be a full relationship that is not encumbered or disadvantaged in any way across that relationship. And I think that's critical. And that takes a lot of capital to be able to do that. Number two, I really think proprietary brands are very important. And so retailers are spending more of their time developing brands that you could only get in their venue. And that's very important if you think about kind of the competitive threat of someone like an Amazon.
One trend that we are seeing now, which is not specifically related to consumer, but more to the, I would say, M&A market in the current environment, is that they are reluctant to launch full-blown M&A processes and auctions. And so what happens and what we see, and actually what we help our clients with is to organize one-on-one discussions or limited auctions or anything that would, I would say, permit to get in the game ahead of a potential future larger process and enable a transaction, while at the same time not going full scale with a full process. So we're seeing more of these type of discussions between sponsors, but also between corporate and sponsors, meaning that we are introducing some of our corporate clients to some of the sponsors we know well, to have, I would say, informal discussion on specific assets that previously might have taken place in the context of a full-blown process.